Hello and welcome to another episode of Leaders in Lending. I'm your host, Drew Megrey, joined today by Rick Moore, the Chief Lending Officer at Maine Savings Credit Union. Rick, welcome to the podcast and thank you for making the time to join me today.
Hey, Drew, and thank you very much for inviting me to your podcast. It's great to have a partner like Upstart that takes the relationship to this next level. The work that you do is very important to many of us in the industry, so thank you for what you do and keep up the good work.
Thanks, Rick. I always find this opening topic very interesting with each guest because there, of course, is many different paths, right? With that said, as I typically do, Rick, I'd like to start off our conversation by giving the listeners, your path to what got you into the financial services space and what did that journey to becoming the Chief Lending Officer at Maine Savings look like?
Well, I have to say, Drew, that my career journey that spans almost 39 years now at Maine Savings is something I've privileged to share in staff meetings across our branch network. While I indulge on this opportunity, I recognize that some of this may not be as exciting to you and your listeners, but many of our staff at Maine Savings has commented on how they enjoy some of the history of the credit union that I've been privileged to experience. I'll spare your audience a lot of the specific events that make my story relevant to our staff, but really, it all starts 4 years before I was born. In 1961, my father-in-law was in the railroad yard of the local railroad company, and the founder of the credit union came up to him asking if you'd like to join a credit union, start a new financial cooperative. My father-in-law didn't understand all of those that meant to him, but he put his 25 cents in and became one of the charter members of the credit union. I'd have to say that at the beginning of my career with Maine Savings, it was a thrill to be part of a legacy from my father-in-law, who then shortly thereafter started talking about how he would go to the founder's kitchen table, and talk about borrowing funds for a loan. It may have been like for $300 or $500, and the CEO would say at that point, "I'm sorry, we don't have the money right now to lend you $300. We're not big enough. People have to make a few more payments. So you come back in another week or so, and I'm sure we'll have that money available for you." So he remembers those days of old when the credit union was just starting out around the kitchen table of the original CEO. So that kind of history is fascinating to me, and I watch it grow to where it's been, to where it is today.
Yeah, so in 1986 is when I really started with Maine Savings. I started as the loan and collection officer. I had one branch, 8 employees, and about $20 million in assets. One of the things I really specifically remember in 1986 was that we actually started our credit card program back then. And I just recently found out in the last couple of years that 1986 is really when credit cards came to credit unions. So it was an interesting learning curve to figure out what credit cards means to us. So as the lender and the collector, I found out really quickly that I not only married them, I buried them. So I did the collection part of the process on a daily basis, as well as do the lending. So I was involved with repossessions, foreclosures, the hard stuff. But over the years, I've really kept the mantra that bad things happen to good people. And I know that's really what the aspect we all need to keep in mind. But with my experience in the collection area, it almost makes me want to think that the first year of every lender probably should have training in collections. If they knew how to collect these loans, they'd probably be a much better interviewer, a much better lender, and understand the reasons why collateral is really collateral only when you get it perfected. So it's one of those areas I think is really important. Now, but from that point, I became the branch manager of that original branch, but convinced the CEO to start a new branch in my hometown. I was about 25 miles away. And he says, "That sounds like a great idea, Rick. What we need to do is you need to develop SEGs." So it gave me that experience of going out and gathering, I think it was up to 40 new SEGs. They were churches, snowmobile clubs, small businesses. And we opened that branch successfully. And there I became the branch manager for 12 years. It was such a rewarding experience to be the active manager in the town where I lived. Although a A trip to the store could often take way more time than I expected. And my wife was pretty much knew that if I didn't come back soon, I was probably caught up with the mouth talking to somebody about business, which she fully understood. It was really during that time that I fell in love with mortgage lending. That thrill of helping that first-time home buyer get their first home. Obviously, the American dream is to own your own home. We were fully engaged in doing mortgage lending back then. Our new CEO was very much a mortgage lender, and we took off very quickly with mortgage lending. It was very rewarding. But it took its time that the CEO saw something in me, and in 2000, he asked me to become part of the admin team in the main office and changed to the Hamden office. And he wanted me to become the director of the lending area at the credit union. This is where I was really exposed more to the business lending. We had done some business lending, but we were really taking off at that point, and my expertise became more broadened. And the slow growth of business lending was really fascinating over the next several years. At this time, I remained very connected with collections. I was always one that they would call upon, even though I wasn't part of the team. They always wanted to call on me for my experience with the mortgage area or repossession. So it was always a good thing to keep that connection there. And obviously now as the VP of lending, I was part of what I oversaw on a daily basis. Over the next 5 years, I earned a spot on the senior leadership team, which led me to the senior vice president of lending position. Last year, my title was officially updated with part of the senior team as part of the C-suite as the chief lending officer. It's been an amazing journey as we find ourselves at almost $800 million in assets and 11 branches. I'm thankful for the opportunity and the people that gave me those opportunities throughout the year to be a leader that I have become today. I always try to tell my staff, I try to empower them so that they can make me look better. And that's always a good thing, right? So I appreciate the opportunity to tell my story, the abbreviated story, and a little bit about the credit union history, because I believe that's probably one of the things that the credit unions don't tell very well is their story. So with this type of a podcast, it's great to be able to have that option to tell the story of Maine Savings. I hope that satisfies what you're looking for, Drew.
It does. That's awesome. That's in reflecting back on that, it sounds like you were destined to be in the financial services space. Then, of course, sitting at the dinner table with your dad talking about lending at such a young age, of course, you were destined, of course, to be in the credit union space. One thing I do want to touch base though on is, you had a very elongated period there of working your way up and a lot of growth within Maine Savings over the years, but let's rewind back to, something that you brought up of your love of mortgage. So to frame up our first topic, about 31 short years ago, and Rick, I would assume you were a part of this, Maine Savings and 6 other credit unions founded a mortgage CUSO. And for the listeners that don't know, CUSO is an acronym for Credit Union Service Organization. And that CUSO today is now the largest credit union-owned mortgage lender in the state of Maine, and one of the top 5 largest multi-owned CUSOs within the U.S. So mortgage lending in Maine is big. But let's dig into it from the opposite direction, Rick. So a lot of our past guests have discussed, their excitement about the transformation of lending and what they're doing in this space, which of course we'll get to later on. But I wanted to start by diving into a point you made when we first met, Rick, which is a part of lending, particularly mortgage lending to be exact, that's not exciting you right now. Can you talk a bit about why your premonition that the mortgage origination space in the short term isn't exciting you like it once did?
Yeah, that's a really good point. Like you said, we are one of the leaders in the state for mortgage lending, have been for many, many years. It seems very different over the last 18 months or so. We've seen our production go from very strong, both in the refinance and the purchase markets, but it has tapered off significantly. As we continue to experience, the prices of homes have climbed dramatically. But with a lower rate environment, we saw home purchases remain affordable, but strained. In the last 18 months, the increases in interest rates have all but put a stop to the refinance business, which was great business. In addition, home prices continue to increase with very low inventory. So times for homes in the market dwindled, with many homes selling for thousands over asking price. And we've actually saw a lot of bidding wars taking place. During COVID, it was amazing how many people came to the state of Maine because they wanted to get out of the big cities. They were buying houses unseen. They were just taking them off the market, paying ridiculous prices, which threw the market in a significant upspin for purchase prices. But it was an interesting time. So it certainly does divest our relationships in the state, but we're interested to see what the next process is going to look like. But what this whole process has done is I've taken our affordability from over 60% of our first-time home buyers to approximately 30% of our first-time home buyers. Most of our kids, including my son, are forced to stay at home and live with mom and dad. It was a welcome trend when we started seeing mortgage rates heading towards 8%. Now it's relaxed and significantly lowered, closer to the 6% range. It is also interesting that over the last 60 days, we've been hearing from our realtors that there's actually the no offers for 30 days has become a statistic again. Prior to that, there was offers happening the same day, certainly within the same week. We're not seeing more homes on the market. While it was good for origination and mortgages, it will certainly have a negative impact on prices. The supply and demand will eventually bring home prices down a little. However, with many people sitting on their 3% or less mortgage rates, we'll see continued reluctance to sell and to easily double their interest rate costs if they were to buy a different home. This will certainly keep the volumes of purchases a little lower than the boom times of housing turnover that we saw in the previous 5 to 6 years.
Yeah, I am fortunate enough to sit in that cohort that is going to stay at home given the sub 3% mortgage refi during the COVID times. But let's touch on some statistics here that kind of point to your point. There is, as of last month, of course, home prices nationwide, not just particularly to Maine, are up 3% year over year. The number of homes sold have decreased by roughly 4%. And shockingly, the number of homes for sale have risen, roughly 16% or so. So let's talk about mortgage lending getting exciting. We both know that we're probably within our careers, Rick, not going to see mortgage rates where they were in 2020 and 2021, given the rates that were in the environment during COVID. But with more rate cuts on the horizon, the increasing supply of homes, what does a path to excitement in this space look like for you?
I think really looking to those statistics to gain more momentum. I do see that, like you said, there are more houses for sale, which is great. Hopefully we'll see those things, see that continue on in our area. Mortgage rates coming down to closer to 6%. It's starting to get a little more excitement in our mortgage lenders. We're actually starting to see our pipeline grow significantly. That's growing by the millions of dollars at this point. So we're seeing that excitement start. It's at the time of the year that we're at the end of the season. That's not typical. So it's obviously having some impact on the buyers in the markets today, which is exciting to see us as we carry through the winter months when it's usually slower anyways. With this new trend, it's starting to get a little bit more of that excitement back in the heels of our mortgage lenders.
Yeah, so something we've, of course, talked about here is supply's up. Right. Demand, however, is down year over year, 6%. I'm interested to get your take on why is supply up, but demand continues to be down. Do you think it's a rent versus own, or is it a thing of kids coming out of college into the workplace, just can't afford the homes and all that it entails, such as insurance and the cost to maintain a home? Or what's your take on why is supply up, but demand continues to fall?
Well, I think you touched on a lot of the real reasons why people aren't buying. First of all, the prices are still up. Prices are still, the national statistics say that prices are still climbing. I think that's a lot of not looking as close to the real action that's taking place. A lot of those numbers are still lagging a little bit. We're seeing prices have started to level off and even seen a little bit of tick downward in some areas. So that is helpful. But there's certainly, those people graduating from college, they've got a lot of student debt. It's almost a second mortgage in itself. That's really keeping some of those on the sidelines. Interest rates still, while at 6%, better than 8%, is maybe a lot of people are waiting for, rates are going to come down. Rates are going to come down. They're hoping for that. The economics are still pretty strong. The unemployment rate is still low. It's ticked down a little bit further over the last couple of days. So those things are really helping to boost, consumer confidence. And I see that is something that's going to continue to help, hopefully gather some more momentum, see the rates maybe decline a little bit further, maybe see a little bit of reduction in prices as people are keeping their houses on the market a little bit longer. They maybe want to reduce their prices. So I think we're hopefully poised to see some uptick in purchases over the next 6 to 12 months.
Yeah, I agree with you. It's probably not going to be at a large capacity. So to touch further on that, let's reflect on the borrowers that, to your point, are sitting at a sub 3% mortgage rate. What do you think the mortgage industry is going to do from a HELOC perspective, as we could potentially see another 200 basis point decline by the Fed over the next, let's call it 12 months or so? Do you think that HELOC space is going to continue to catapult as it has been over the last 12, 18 months? Or do you think there's going to be more individuals using the equity in their home for a cash out and extending term and increasing their rate potentially?
Well, we see the needs and the demands for home equity lending to be outpacing any other year. There's a lot of people sitting on a lot of equity with again, values going up. People are using their equities for many things. They are, again, stuck at that 3 or sub 3% mortgage rate. So they're not going to refinance to be able to put on that new addition. They're going to do a home equity. And that's what we're seeing a lot of. We're actually seeing a lot of people taking advantage of their home equities and buying other properties. So we're seeing a second home or a seasonal camp or cottage on the lake. We're seeing that continue to be a striving factor in what we see on a daily basis. I don't see that's going to lower any demand anytime soon, as a lot of people are sitting on trillions of dollars in equity, and we're seeing a lot of activity on a daily basis.
Yeah, I would agree with that. That is the same type of conversation that I hear across the industry. So it'll be interesting to see the change of pace of how the mortgage industry moves forward here in the next few months. So let's fast forward. We've talked a lot about mortgage. Rick, as you and I both know, mortgages, of course, are one of the largest portions of most financial institutions' balance sheet. And for credit unions, it's right around that 40 or 50% range or so. But with your notion of a decline in mortgage originations in the short term, what is Maine Savings' plans to leverage or augment the balance sheet going forward with that decline?
Yeah, Drew, we are seeing that hit our balance sheet with mortgages and not having the origination. So people are still paying off, still moving. So we're seeing that balance is going down. So we're looking at other options. And that is one of the bigger areas that we found a great benefit from when we started a referral program from local car dealerships. It wasn't intentional. We obviously didn't have the old golden rule apply for us that we saw what was happening that far ahead, but we started getting a lot of local dealers who wanted to work with us. We've never been and now don't have the intentions to become an indirect lending shop. But these small dealerships have given us plenty of referrals, and we don't pay them any dealer reserves or referral fees, so it works out well for us. They're thrilled to be able to have the fast and consistent decisions for their buyers. It has been so beneficial that the original referral dealers that we had spread the word throughout our local branch areas. This has continued to grow. with that part of our business over the last 2 or 3 years. We have seen our auto balances grow 15 to 18% each year just from the small organic growth from these small dealers with their small relationships that they've developed with us. It's been very beneficial for us.
That's awesome. And one quick question off of that too is you mentioned you don't do indirect lending, but this is somewhat in a sense some type of indirecting. Of course, you don't have the cost associated with what comes from indirect lending. Do you have any insights for our credit union and bank listeners that are also not in indirect lending today on the best go-to-market strategy to leverage this asset without managing those dealer partnerships?
Well, certainly they have to have the ability to pivot quickly and to be able to make sure that the borrowers and the lenders are always on the same page. The dealership relationship is something that has been very beneficial for us, but also for our members. They're looking for those little bit lower price vehicles that they can't get at the big dealers. Those big dealers that have the higher overhead. So these small dealers have really been a huge benefit for our members as well as for us. So keep your eyes open for those type of relationships that can benefit not only you as a credit union or a small community bank, but that can help your constituents, your members, your customers be able to get a better deal. Obviously, be careful. There are a lot of the small dealers out there who maybe not selling the best quality of vehicles. So we've had to take our stance with a few of those that think that they're going to make a couple extra $1,000 on a not such good quality vehicle. So just one of those things to be watchful for. Watch those times for the title applications not being processed properly and quickly by those dealers. But it's been really a great eye-opening relationship that we've been developing, and it's been very beneficial for, again, the credit union and our members.
That's great. Thanks, Rick. So we've talked a lot about secured assets, mortgages, automobiles, a lot of the types of loans that most financial institutions, of course, want to put on their balance sheet. But with the decline in originations, of course, to mortgages, and then, of course, the smaller dealer network that you're leveraging today, how do you think about the secured versus unsecured diversification in the current environment and in the future environment as the macro begins to stabilize to leverage your balance sheet from a return perspective?
You hit a good spot on our balance sheet. We definitely need that diversification. We need those higher yielding loans. This means the focus on unsecured loans and credit cards has increased. We've seen a significant growth in our unsecured balances with the help of Upstart. Certainly our partnership has been very beneficial to us. It allowed us to grow that business with good yields, as well as the confidence and the expertise of the Upstart decision matrix. While we limit the production to only $1 million a month, we've certainly seen a steady growth of our unsecured balances that has fed that portion of our very hungry balance sheet. At the same time, we continue to work on our credit card vendor to increase limits or offer those special transfer balance promos. As strange as it sounds, every time we offer one of those balance transfers, we see 80 to 90% of those balances stay after the promotion. I think we can I'm pretty sure we can attribute that to the fact that we are a local serviced credit union. We service all of our credit cards ourselves, and it really stands out to our borrowers. They can get local professional help when they need it, and they know they're talking to their credit union. So I think that has helped retain, again, that 80 to 90% that we've always gathered from each of those promotions we run.
Awesome. So mortgage lending is decreasing in the short term. We're going to juice things up from an auto perspective. And of course, we're going to need to maintain some type of diversification so the balance sheet is maximizing your return. I think I summed up our conversation here pretty well. Rick, as you know, I always like to close the podcast out with 3 questions, so I'll just go rapid fire here. What is the latest and greatest app or technology gadget that you absolutely cannot live without?
That's a great question. I really like technology and gadgets, but the thoughts I had was not towards the highest tech, but for something that makes my life easier. That's what I concentrate on. With the busyness of our lives, I'm really falling in love with that fresh food delivery on a weekly basis. Just taking us away from our talk on finances. I happen to use a company called Hungry Root, which is referred to me by our CEO, who had 2 food allergies. It's the only fresh food delivery service that would accommodate for both of those issues. I don't have any food issues, so just found the convenience of getting a variety of foods with average prep time starting for around 15 minutes to be amazing. On top of that, the amount of food waste is almost eliminated. And I don't have to stop at the store 3 or 4 times a week. I don't know about you, but simplifying this part of my life has been very liberating.
I'm right there with you. I am guilty. I am not an expert in the kitchen. I'll plug HelloFresh. It helps with busy lifestyle and being able to have food prepared for my children pretty quickly. All right, question number 2. If you could switch jobs with anyone for a day, who would it be and why?
My first thoughts went to people like Warren Buffett or a strong political leader like our Maine Congresswoman, Susan Collins. However, I really thought it would be amazing to be someone like Scotty Scheffler, one of the top professional golfers in the world today. It'd be amazing to be on top of the world's greatest athletes and your profession. I love his consistency, his control over his emotional and mental faculties. What really focused my attention on him was the ordeal he went through earlier this year when he was at a disturbing and unjustified detainment by the police on the morning of the final day of a professional tournament. He was released with no account of wrongdoing, but ended up arriving late to the tournament. He couldn't do his normal warm-up or his practice, but ended up coming in second place. To have that kind of mental and emotional stability puts him at the top of my list for amazing people. For me, being a wannabe golfer, this is incredibly motivating. If during that one day I could pick up on the mental strength he possesses while learning a few things to make my golf a little better, it certainly wouldn't hurt my feelings any.
We're 2 for 2, Rick. I would also agree with wanting to be Scotty Scheffler, given what he went through at Valhalla a few months ago. But I also enjoy the game of golf and wish I could produce scores as such as Scotty Scheffler. So last one does not need to be pertain to lending in any facet, but what is one bold prediction for the future?
That's a challenging question.
I'm sure this one will disagree with.
But maybe not. I think there's no doubt that a lot of bold predictions about the economy and interest rates, but that's not where my mind first went. My thoughts went to AI, or artificial intelligence. My prediction is that AI will morph to a stage in the next 5 years that we will not recognize our industry or even interactions with service and technology companies around the world. While this all sounds and feels scary, we've all watched those sci-fi movies where the computers take over the world, and I'm confident that this technology will simply enhance our lives. It will get us to the point I keep preaching on to my staff, that we want to work smarter and not work harder. Who knows? Maybe this could get us to the 4-day work week we all want.
Well, I think we're 3 for 3. Of course, I have many bold predictions, but I would agree with you on the movement of AI is going to definitely elevate in the very near future. Well, that wraps this episode of Leaders in Lending. As always, thank you to our listeners. And Rick, again, thank you for taking the time to join me today.
Well, great. Thank you very much, Drew, for having me. Good to do a great job, and I hope you continue on this great service.